The intelligent investor. First, know your role. Are you an investor or a speculator? An investor buys a stock because they understand the business and believe it as fairly priced based on its intrinsic value. The true worth of the business. They're looking for long-term growth and stability. A speculator, on the other hand, buys a stock because they think the price will rise in the short term. They're riding the wave of market trends or emotions, and they're not interested in the underlying business. Graham insists you must clearly know which one you are and avoid mixing the two. Second, the Mr. Market metaphor. Imagine the stock market as Mr. Market, a partner who offers to buy or sell you shares each day. Sometimes he's optimistic and overpays. Other times he's pessimistic and underprices. Your job is to take advantage of his mood swings, but only when the price is attractive. Don't chase rising prices. Third, margin of safety. The difference between a stock's intrinsic value and its market price. Buy only when the price is significantly lower than the value so that even if things go wrong, you have a cushion against loss. Fourth, defensive versus enterprising investor. A defensive investor wants safety and minimal effort. They invest in a well-balanced portfolio of high-quality stocks and bonds, usually in a 75-25 split. An enterprising investor is willing to spend time and effort researching undervalued companies, special situations or market inefficiencies. Both require discipline, but the choice depends on your personality, time, and skill. Fifth, investment strategy guidelines. These are the rules that every intelligent investor should follow. Diversify to reduce risk. Don't try to time the market. Focus on the long term, not short-term fluctuations. Always demand a margin of safety. Be skeptical of hot tips and hype. Sixth, the role of bonds. Graham advises keeping a mix of stocks and bonds, usually in a 75-25 split. This can be adjusted depending on market conditions. For example, during a bond market boom, you might shift to a 25-75 split, but never keep 100% of your portfolio in one asset class. Seventh, psychology of investing. Your biggest enemy is your own emotions, fear during downturns and greed during booms. The intelligent investor stays rational, even when others panic or get euphoric. Big takeaway, the intelligent investor is less about picking the perfect stocks and more about building a mindset that avoids big mistakes, protects your capital and steadily grows your wealth over decades.